I want to start, if it's okay, of course, with last week's note, not the week over the weekend, when you said the Fed meeting is critical for the rally to continue, pause, or even end completely. Mike, when I watched that Fed meeting, I was kind of kneeling or kind of leaning into the end of that one, maybe it ending. Why can this continue?
Yeah, thanks, John. Good to see you. I mean, look, we got to be flexible here. And what I would say is that the message last week from the Fed was pretty mixed, right? The statement itself was dovish. You know, the market rallied off of that. And then the press conference was a bit more hawkish. And look, this is the ambiguity that we have now, right? People have to interpret these statements and these reactions on their own. It's not going to be that exact anymore. The Fed doesn't exactly know how they're going to end this, and neither does any investor, including ourselves. What we do know is that we're getting closer to the end, and the rate of change probably on the pace of hikes is coming down. And that's our forecast, 50 basis points in December, 25 in the January meeting, and then they pause from there. And that's a quick ending. So that's enough for the bond market to potentially rally at the back end, particularly if we get the outcome in the elections that we expect tomorrow.
Let's get to the midterms in a moment. Do you consider the end of hiking the end of tightening? And it sounds like you do, so let me ask you this. Would you consider a Fed that pauses and stops hiking, but a recession that rolls over to be tightening or not?
Well, it's all one and the same, right? So the Fed is likely going to achieve its goal. It already has in terms of slowing the economy. Ultimately, I think they'll be successful in getting inflation down because it's not really about the Fed so much as it is about the excessive fiscal spending and of course, what that did to demand. And that is already fading because of demand destruction from prices and, of course, as people run out of money. So I think it's all one and the same. And look, the trickiest part here, John, is that, do we decide, is there going to be a window of opportunity between the end of the Fed hiking cycle and the recession itself? This summer we wrote about that. We said it's too early to think about the Fed ending its rate hike cycle, so we didn't try and play that rally. This time, though, we think there could be this little window of hope, particularly at the year end when there's pressure to perform and people have to chase stocks into year end potentially. And as Taylor was saying, the midterms historically are a positive catalyst for at least for the month of November.
Well, let's talk about where you want to be long within the equity market. The recent outperformance in the equal weight S&P over the last couple of weeks is clear for all to see. What's the signal you take from that, Mike?
Well, I think that the equity market leadership is fading, right? So technology has been a massive underperformer this year, consumer discretionary as well. We've been underweight those groups. And the question, of course, is what's going to take over? And I think what's interesting, what we're trying to do, John, is, we look at the internals of the stock market to help guide us. And we're getting close to the end of the bear market. We're not there yet, but what you want to try and figure out is what outperforms in the last leg down, and because that will tell you what's going to outperform in the next leg up eventually when we get there. And that's been industrials, financials, and some of the commodity complex. And that makes perfect sense to us, right? In the next economic expansion next year, we think that there will be a major leadership change from the former leaders to these new areas.
You think tech gets left behind?
Well, look, the reality is that there are plenty of good tech stocks that will be fine. The reality is that there's too many of them. Right, and they got overvalued. So it's not that technology is dead in terms of the spending trends. We're very bullish on technology spending. However, there's too many competitors now, and the valuations just got out of whack. So we got to take that out. And yeah, so there'll be a lag. There'll be a laggard probably in the next recovery cycle, but that doesn't mean there aren't great single stock opportunities within that.
The midterms, let's go there. It was in your note this morning. Is that just a risk event, Mike, we need to clear, or does it have outcomes that have consequences one way or the other?
I view the CPI as kind of this risk event that needs to just get it out of the way. It's sort of like, who cares? It's backward-looking data anyways, but we got to get through it, and then we're pretty confident that 6 months forward, inflation will be materially lower. That's our forecast, and so it's just that's kind of the risk event that just has to come and pass. The midterms, though, however, could have lasting implications if it's a decisive victory for the Republicans, because as I said before, we think the majority of the inflation spike was a result of excessive fiscal spending, and that, of course, will be curtailed even if the Republicans just win one chamber. That's not to say that the Republicans are fiscally conservative incredibly fiscally conservative, but it does throw a wrench into this idea of a single party, which the market also likes, the idea that no one party having single control. So ultimately, it should be good for bonds. Bond yields lower has been key to our tactical rally call, as you know. And look, I want to make it perfectly clear, John. If we don't get rates to come down, the rally's over. We had it 39, 39.50, but we see enough in the tea leaves and enough in the technicals to suggest we should hang out and see these two events this week play out first.
Mike, different views though, and you've written about this in the past, so I'd love your view on it now. Are rates going down because there is this increased perception that the cycle's ending, the hiking cycle's ending, or are rates going down because perceptions of global growth are rolling over? And in the near term, I get it, you trade on just the move, but when do you start to trade on the reasons for the move into next year?
Yeah, look, so we have to kind of serve many constituents. This is a trading call, okay? For our core, kind of view, we remain of the view that the bear market is not over, primarily because of the view we've had all year, which is that earnings ultimately will decide the end of the bear market. And we think earnings expectations for next year are significantly too high, maybe as much as 20%. And that will happen over the next 3 to 6 months, meaning the numbers will finally come down. Part of the reason we threw in the towel on that happening now is because we just got a sense that companies wouldn't talk about 2023, which they did not, and therefore the earnings remain high for next year. But I want to make it clear, over the next 3 months, we think that will change. We think companies will discuss 2023, and the reality will set in that the numbers have to come down. That will form the bear market low probably sometime in the first quarter next year.
Are we seeing signs of that now with some of these tech companies, Mike, reporting cuts, hiring freezes or layoffs?
Well, let's separate that because first of all, we saw many of these large tech companies report, pretty weak third and fourth quarter. But then when you actually look what happened in 2023 numbers, they didn't come down that much, at least for the majority of them. And part of that's just, kind of laziness of the numbers. Nobody talked about it, so they just kind of keep them there. But then I want to talk about the cost cutting. Okay, so look, this is what will get us bullish. By the way, if we saw more aggressive cost cutting, not just by the tech companies, but by companies more broadly, this acknowledgement that we have a cost problem. And, obviously we don't want to see people get fired, but, layoffs, unfortunately, are a part of that slowdown. When that layoff cycle picks up in earnest, that will actually be one of the keys for us to get bullish, because that means the bleeding will stop on the operating leverage.
Final question. You hinted at the answer to it a little bit earlier in the interview. I've asked this question all morning, Mike. You get the choice, the outcome of CPI or the outcome of the midterms right now. I can give you one. What would it be?
If I could see it right now, Clarence speaks, I would say I'd probably rather see the midterm election outcome, because that has more lasting impact potentially.